Well, it looks like we are back together again, and we have folks joining on to the webinar. It is 4 o'clock by my time, and I just want to say welcome everyone to today's market update. I'm Greg Patterson, and I'm joined with my teammates J.A. Kennedy, Tara Gould, and Jen Mann, and we are with Atlantic Wealth Management here in Morehead City. And this is our second market and economic update of the year. Our last one was in January, so we are glad you've joined us today. It is a beautiful day in downtown Morehead City. We've got 63 degrees. The sun is shining, and we are barreling down at towards the end of April. So each quarter we strive to bring you the latest on markets, the economy, and our thoughts about where we are headed. We hope that these virtual meetings and this format is valuable to you and your loved ones, and that you can benefit from these. Should you have any questions or feedback for us, we would welcome your questions or any comments that you have. You can direct those to us by email or by telephone call. If you're going to send an email to us, we would ask that you send it to our teammate Mackenzie, and that's Mackenzie at myatlanticwealth.com. We appreciate your questions and feedback, and we do welcome those. We try to answer those as well. And then lastly, I'd like to point out that we host these calls every quarter. So our next one is scheduled for the summer. That would be July 27th. That's also a Monday at 4 p.m. So go ahead and mark your calendars for that. We invite you to forward this invitation to friends and family that you think may benefit from these updates. Also, we'll post these to our website once we get compliance approval, and that allows you as our clients and friends to be able to share those on demand with those that you care about. And we ask you to do that because it may benefit others from the work that we do. So with that, we have a lot to cover this afternoon, so let's go ahead and get started. You can see the information there in front of you. We're going to talk about several things today. There's a lot on the news headlines, and ever since February 28th, really, that's been directed towards the Middle East. But we'll take just a minute for a timeout to review our 2026 year-to-date market performance. I will also do a deep dive on the economic updates and outlook therein. We'll also talk about policy and geopolitical updates, even the Middle East. We'll talk through financial and tax planning updates, things that you should be thinking about and considering. And then finally, we'll wrap this up with some bullet-pointed action items that can help you and that we think you should take considering our advice. And lastly, we'll just wrap up with some conclusions. So with that, Tara, can you share an update on how markets have performed this year so far?
Yeah, sure thing. So I want to start where markets are year to date. So we're talking January through actually last week. And as you're looking at this, what stands out immediately to me is just the uneven performance across sectors. So we are looking at S&P 500, top 500 companies domestically. We have energy. So energy is up 27.6 year to date, followed by materials at 14.6 and industrials at 11.6. And if we look at the opposite, we look on the other side, we're seeing weaknesses in areas like financials, which is down about 5.5%, and also healthcare at down 6.4%. If we look at the S&P overall, roughly year to date, up about 5.1%. But when you hear that, that headline doesn't necessarily tell the whole story. As you can see in the different sectors, there's a wide range of outcomes depending on where you are invested. I like showing this because this is a good example of just sector and market rotation. Leadership shifts over time, and this just reinforces why it's important that we stay diversified rather than trying to just chase what's working in the moment. If we look at this chart, in a couple weeks, it could look very different.
Mhm.
So, from a planning perspective, this type of dispersion is normal and it is something that we expect to see throughout the year. And then just taking it a step further, this slide is going to give us a broader look across the major indexes. So we talked about S&P 500 year to date. Also, we look at the Dow, which is up. Small caps, which are represented, so smaller companies, those are represented by the Russell 2000. Those are up about 12.67%, which is definitely a notable shift in that leadership this year. We're definitely seeing some strength internationally. You can see emerging markets are up 15.3%, and the developed markets, which you'll see, we call it the EFE or EAFE, is up 5.6%. Another difference I want to highlight here is value versus growth. This is a conversation we have on the regular. And right now, value is up 8.73% year to date, while growth is up just 1.4%. So this is a reversal from what we've seen in recent years. And as we zoom out, just looking at the longer term numbers, they can also tell a different story. S&P 500 over 32% over the past year, and cumulatively a rate of return of 80% over 3 years. Again, why do we show this? It's fun to look at the rates of return and see how markets have moved. But again, it's to emphasize why we stay invested. The path is not always smooth, but that long-term discipline and participation in the market historically has been rewarded.
Very good, Tara.
Thanks.
All right, so I'm going to build a little bit on what Tara just talked about. So each week we meet as a team to discuss the most recent economic data, as well as overall market performance, both short term as well as longer term, and historical trends as well. We meet on Mondays, as a matter of fact. So looking at this slide, if we focus on US equities or stocks, the charts we see on this slide provide a breakdown of US equity performance across different company sizes, so large, medium, and small companies, and different investment styles. So as she talked about, value and growth, and then a blend of the two. And we're going to look at them over 4 distinct time frames. So this past week showed some modest mixed performance across different market caps and styles. But since performance is going to vary from day to day and week to week, we generally like to focus our study of performance trends over longer stretches of time. So if we broaden our look to 2026 thus far, the year-to-date figures show a clear preference for value and small to medium cap stocks. Small cap has been our strongest performing category year to date at positive 14.6%. Medium cap performance has been strong in value and blend at 10.8 and 8.1% respectively. Large cap companies have also seen steady growth, particularly in value, significantly outperforming large growth. Now, if we shift to our boxes over on the right in the gray, while value seems to be leading the charge in 2026, the long-term data highlights the historical dominance of large cap growth. If we focus on our 10-year annualized returns in this box, large growth has been the strongest long-term performer, returning 18% annually. Value stocks have shown great stability over the last 10 years, which is great. They've consistently returned anywhere between 10.3 and 11%. Larger companies have generally outperformed smaller ones over the decade-long period. And finally, since the market peak in January 2022, large growth at 58.8 and large blend at 57.8 have seen the most significant cumulative gains since the peak. So in a nutshell, the broader trend for 2026 has heavily favored value and small cap. Historically, however, large growth remains the leader in total returns. So that's equity. So if we shift to the next slide, we'll take a quick peek at fixed income. So performance in the fixed income or bond sector is something we also monitor very closely, since a good number of our clients have at least a portion of their portfolio allocated to fixed income. So here we see a snapshot of performance across various fixed income sectors, comparing current yields and total returns over several time frames again. And a few interesting data points to note. So high yield bonds lead the group with a yield of positive 7.22%. Performance-wise, high yield bonds are also leading both year to date as well as over the last 3 years. A few other trends for you. The fixed income market, it can experience volatility just like the equity market on a day-to-day basis. Most sectors saw slight negative returns over the last week, which may suggest a period of cooling or rising interest rates. Every sector listed has maintained positive returns on a year-to-date, 1 and 3 year basis. And the data also kind of shows us or gives us a better look at the risk-reward trade-off. So as an example, while high yield offers the highest payout, it typically carries more default risk compared to US corporates or even municipals. And so talking through all of that, we always like to jump to the next slide, which ties it all together a bit. This next slide, you may have seen it before. It's one we'd like to revisit frequently because as we've discussed, we consistently monitor both equity and fixed income performance over both the short and the long term, even when we see trends that may be concerning or weeks that could seem extra volatile, because it just helps us to refer back to what we've seen going back for a number of years. So this intra-year decline slide, it illustrates a key lesson in investing, and that's that stock market volatility is actually normal, and it often happens even during years when the market ends up with positive gains. So the chart looks kind of busy, but there are two big things to point out. So we're going from 1980 to 2025. So our gray bars on the chart are showing the total return of the S&P 500 for each full calendar year. The red dots are showing the largest drop in the S&P 500 that happened during that same year. So when we take a good look at this, the key takeaways. So volatility is constant. Every single year shown has had an intra-year decline ranging from a small negative 0.2 to a more severe negative 49%, but they all have had them. Resiliency. So despite an average intra-year drop of 14.2%, annual returns were positive in 35 out of 46 years shown. And to highlight a few extremes, so in 2008, you'll see the largest intra-year crash was about negative 49%, but the year ended down a little higher at negative 38%. If we go way back to the beginning, 1980 had a significant 17% drop mid-year, but finished with a sizable gain of 26%. So finally, if we look at the current year, so put some context on 2026. So as of the end of last week, the S&P had seen a negative 9% intra-year decline, but it's currently up about 4% for this year. So that negative 9% on the S&P 500 happened right around the end of March, which means the values reflected on some of your month-end statements dated March 31st likely reflected that level of decline. But as of Friday, the S&P 500 was up roughly 8.7% thus far in April. So it's been a good month overall, at least as of Friday. So the big picture, the average annual return over the period of 1980 to 2025 was 10.7%. So like we always say, staying the course through periods of volatility, it can often feel challenging, but investors who stay in the market through temporary, as we see here, red dot drops often benefit from the positive gray bar finishes in the long run.
So that's a great chart, Jen. Good job.
It's a helpful one.
Before I jump into an economic update or overview, I thought we could lighten things up a bit with some humor. So here we have Bob sitting on the couch. He's watching CNBC, and here's what he hears. despite the installation of trampolines on the trading floor, Wall Street failed to bounce back today. So there's some humor in that and also some reality. If you pay attention to the market somewhat or closely or semi-closely, then you can relate to this, especially this year, as we've seen, I think, an abnormal number of days where we've seen large extremes on the upside and the downside, even intraday, trading. Market will start out down and end up, or start out up and then down. So I think this is a good kind of metaphor analogy for this year, especially with the results we've seen to this point. One of the things we always do on these webinars is give kind of a brief overview of the economy based on the data that's currently out there. So I'll jump into this and go through it rather quickly, but we'll start out with consumer spending. One of the ways we measure this is with retail sales, and retail sales have continued to be positive. We haven't had a negative month in a long time, and they have been keeping on pace or better than the rate of inflation. So consumers are what prop up the economy, as 70% of the GDP number is driven by you and I going out and spending money in the economy. So that's a positive trend. We also look at personal income and consumption. And similarly, we've seen, increase in that as well. So personal income is up about 3.7% year over year, and retail sales are up about 4% year over year. So positive there. I'm going to go in counterclockwise order here. So we'll jump to jobs. And the jobs numbers have been somewhat lackluster until this latest report, or if we look back over the previous few months. We did have a surprise to the upside with the March employment report. But all that to say that unemployment has remained in check. It has remained in check. It's about 4.3% based on the last data. And we would say that's kind of a healthy level. We also look at initial jobless claims, and they have remained in a very normal range, very healthy range. So that's the jobs front. From a housing standpoint, this is one of the areas we've talked about for a long time. The numbers are mixed when we look at existing home sales versus new home sales versus housing starts. And we've continued to see that. They kind of switch places from month to month, depending on the previous month. The one thing that sticks out is that we've continued to see more new home sales and more housing starts than existing home sales. Although there have been, we've seen a little bit of relief in that market on the existing home sales, even though interest rates on mortgages have not drastically come down. In fact, they came down and then ticked back up a bit. I think as time has gone on, folks have been more willing to sell their existing homes for any number of different reasons. But after a certain point in time, you just bite the bullet, right? If you need to move somewhere. And then we don't have a circle for manufacturing or industrial production, but that has been an area that has been positive over the last few months. We've been waiting for kind of a kickstart or a positive trend in manufacturing, and that has continued over the last few months. So we're hopeful that we can continue to see that. If we jump to the middle there for the middle circle there on inflation, we measure that with the consumer price index most often. We also look at inflation with producers with the producer price index. The consumer price index is right around 3.3% year over year. So prices are up about 3.3% higher than they were a year ago. On the producer side, that's about 4% based on the last number. They did both jump up in the last monthly results reported. A lot of that was driven by energy prices, with the price of oil going up, conflict in Iran. So that it follows that we would see a spike in those things. What we don't know is for how long it's going to drag out and how long we'll see that elevated number. Which brings us to the Fed rate circle there. The Fed does meet this week. I think depending on what source you look at, one said there's 100% chance of no change. I don't know if it's rare that anything is 100% likelihood, but based on where things are today, and I think even the uncertainty about how things track out over the next weeks and months, the Fed's posture has been, hey, we're going to hold things as they are and see how things shake out. The GDP growth number, which is how we measure, health of the economy and economic growth, that will come out later this week for the first quarter. And if we look at estimates out there from various sources, they range from 1.2% annualized growth to 2.5% annualized growth. So those numbers, anywhere in that range, we would say positive is good, but still it looks to be a little slower than if we look at the number for the year last year. So we saw a little bit of tapering down in terms of economic growth in the fourth quarter, and we're hopeful that we can continue to grow, even if it's at a slower pace. Jumping back to just the Fed funds rate and the Fed, we can see this chart shows how things have changed from the beginning of the year, expectations to where we are today. We didn't know anything about what would transpire in Iran and what is happening ongoing now today. So if we look back 10 weeks ago, you can see we were expecting rate cuts this year. So at the end of the year, we were expecting to be about 50 basis points lower. And the more current information and data and projections are that will stay about the same. So I do think the Fed has made comments over and over that they're going to be data dependent or data driven. So we'll have to see how things track in terms of the economic data. But the expectations at this point are that we could very well see rates stay pretty much where they are, unless something drastically changes in the economic data.
That's probably good news. Yeah, so let's talk for a minute about oil and the economy. I really wanted to name this slide, is the Strait of Hormuz open or closed, but the team vetoed that. So it's important to talk about oil and how it impacts us. None of us buy a barrel of oil, but we do put fuel in our cars and vehicles. And so this is a picture or a snapshot of how that has looked over time. And the different colors represent the different years. So if you just take the blue, for example, that's 2022, and you can see the spike up in gasoline prices to $5 a gallon. The orange is where we are in 2026. And so you can see this would be US dollars per gallon of gasoline across the country as an average price. So we are climbing, but it's important to note too that the US is a net exporter of gasoline, fuel, and related products in the top right hand. It also does not fall far from us that Venezuela and that whole situation was done before February 28th, when the US launched their initial strikes on Iran. Markets bottomed March 30th. And I love the chart that Jen spoke about. There's so much to talk on that. The thing you don't see on that is the Time magazine covers going back to 1980. Time magazine has had 5 different covers, war in the Gulf, dealing with the issues in the Middle East. And in particular, some of those covers had barrels of oil on fire. The interesting thing to note is that the price on that magazine over time has always gone up. And that's the impact of inflation. And it's the entire reason that we want to invest money to receive a return on it. So what does oil have to do with all of this? as of late April, the disruption to the global oil supply has reached a little over 13 million barrels per day. And that's according to a report by JP Morgan. So this is about 15% of the world's demand of roughly 100 million barrels of oil. It's actually a little bit below that, sitting around 13%. So there are only a few levers to pull in a disrupted market. The first answer is often spare production capacity. So looking for producers to ramp up and backfill those losses. The lion's share of this global spare capacity is actually located in the Persian Gulf, where the Strait of Hormuz is either open or it's closed depending on the day. Obviously, the markets have been sensitive to that. And this has sent exports out of that area to near zero. We're being told this is short-term in nature, and so we're going with that. And so when we think about oil prices over the last 50 years and how it relates to your money and investments, a rise of 50% above trend in inflation-adjusted oil prices has historically triggered U.S. recessions. We do not see that happening as of right now, and that's just a result of the disruption being less than that 15%. Obviously, the longer this goes with oil over $100 a barrel as the cost, the greater our concern on that. Right now, it's below $100 a barrel. And I think that really is indicative of the nature of this type of situation. To point out, though, the consumer expenditures on energy as a percent of total income are shown in that graph at the bottom right-hand corner. So that light blue is gasoline and other fuels, and the bottom 20% of the income cohort is impacted by that a lot more than the top 20%. So we can, again, I think the longer this goes, the more that we would be concerned about that. If it is short-term in nature and this situation gets worked out, I think we would expect, as Jay said, to see growth in the U.S. economy. And that's obviously why we diversify. It's why we think about issues like this across your asset categories, including fixed income and equities. So shifting gears away from oil and the economy, let's talk about something that is closer to home and more impactful to you guys. Let's talk about tax and planning around that.
Sure thing. So each webinar, after we talk about markets and economy, we transition, or maybe we do sharp right turn into planning, financial planning, and definitely want to give you some actionable steps. So at this time, initial tax season is over, and we're asking that you send over your most recent tax return, of course, along with any updates that are going to impact your financial situation. And we want to look at your tax return because this gives us just a detailed view of your income sources, what you've taken for deductions, and just overall tax exposure. And it helps us to identify opportunities in your financial plan. Our goal in this is to be proactive rather than reactive as much as possible. And if we can identify opportunities now, it allows us to implement those strategies throughout the year. And so the best way in order to get your tax return to us is through Investor 360. Our secure portal, you can upload your return there. If you'd like, you can email those over as well. So we just ask, if you haven't submitted your return yet, we're starting the process of going through those. Please do so at your convenience. It's just a really valuable tool that we have in guiding your plan. And then when we're looking at your tax return, we're thinking through tax planning opportunities and just areas we can evaluate and add value. So I want to go through these. First, if we see a refund or an amount owed, If you're still working, you still have earned income, is there a possibility to adjust your withholdings? So first, if you received a large refund, that means that you've gone without that money for the possibility of up to a year. We deem it as a loan, an interest-free loan to the IRS, to the government. And we want you to have those resources throughout the year in order to make decisions with. Then on the other hand, if you had a large amount owed, we try to avoid surprises going forward, again, if at all possible. So our goal is to be able to dial this in. And one of the things we look at is called safe harbor rules. So for example, maybe your CPA has talked to you about this, but safe harbor rules generally mean, and there's some income information in here, but generally mean paying in 90% of current tax liability or 100 to 100% of prior year's taxes, of course, depending upon income. Next is quarterly payments, especially those that have variable income. Maybe it's from bonuses, equity compensation. We want to make sure that taxes are being paid throughout the year to avoid an underpayment penalty. So timing matters whenever it comes to paying your taxes. On your returns, we want to look at your deductions, and also I'll combine charitable giving in that. So we look at, are you taking the standard deduction versus itemizing? Are there any opportunities there? This year, if you're age 65 and older, there is a additional standard deduction. So you probably heard it referred to as the senior deduction, and this can further reduce taxable income. So it would be on top of the initial standard deduction. From a planning standpoint, why do we care about that? We look at things like bunching deductions, maybe into a single year, utilizing, if you have charitable goals, utilizing what are called donor advised funds, or maybe qualified charitable distributions. We've talked to you hopefully about that if you're age 70 and a half or older. Those will directly reduce taxable income. Income recognition is another key area, particular in years where income fluctuates. So if income is maybe temporarily lower, is that an opportunity in order to recognize additional income at a lower tax bracket in preparation for the need in other years? If you're in a high income year, maybe we look to defer some gains wherever that's possible. And this is also tied to the decision of Roth versus traditional, and just making sure we're intentional about when taxes are paid. A lot of times when I talk with clients, we talk about a single year versus of taxes owed. When I'm looking at a plan, when we're looking at a plan, we're not just looking at a single year, we're looking at over your lifetime and what's the decision that we can make in order to reduce your taxes over your lifetime. To note on the Roth versus traditional contributions, so we're talking about IRAs, employer plans, note that those contributions did increase for 2026 in both categories, individual retirement accounts as well as employer-sponsored retirement accounts. We like talking about Roth conversions. And so Roth conversions are when we move money from a pre-tax situation to a Roth account. So paying tax today in exchange for that future tax-free growth. And the key here is just managing tax brackets carefully. Maybe we have the opportunity to fill up a bracket without spilling over into another one. Another key here is Medicare and those IRMAA thresholds, and keeping in mind that that is a 2-year look back. Also, we focus on those required distributions and income planning. Is there an opportunity before you reach R&D age to where you could recognize some income at a lower bracket? And so we look at coordinating the R&Ds, requirement of distributions, Social Security, maybe you have a pension and also investment withdrawals, in a way that manages taxes, but also your cash flow efficiently. We talked about QCDs a little bit earlier, but I'm going to say it again. We love to incorporate the qualified charitable distributions from those that are RMD age. And lastly, tax loss and gain harvesting. So most people know about tax loss harvesting, but there is also an opportunity for tax gain harvesting. So this just allows us to realize losses, to offset gains, or strategically move gains when you're in a lower tax bracket. This is an ongoing process. And the goal behind this is to produce after-tax income over time. So all of these areas work together. Again, it's not just focused on one single year. Yes, we do look at a single year, but also just a coordinated strategy that improves your tax efficiency over your lifetime.
Very good.
Thank you, Tara.
Of course.
There's a lot of good stuff that she just went over. And the reason why we talk about this, as she mentioned, is to plan and help you from a strategic standpoint to take advantage of key issues there. And I just think about if someone's married filing jointly and their adjusted gross income is below 250,000, but above, say, 98,000, they're going to be taxed at 15% on long-term capital gains, which also dividends would be at that rate. So that would be helpful for somebody to receive income that way above or beyond, say, W-2 wages, for example. So those types of strategic positioning is where we can help you think through this by reviewing your tax return. In addition, from this webinar today, we want you to think about what actions should we take. And we talk about reviewing your cash position. The reason why we talk about this is because generally folks are paying for goals. If you're taking a trip or buying a car or even just having a cash position for a reserve fund, we want to review that ongoing, not just when the market is good, although I think that's it certainly makes sense to do it then. But we want to do this in light of your own specific goals and what objectives you have set out. It's also important to review this cash position because banks today are dropping the interest rate that their clients are earning. So let's say you have 50,000 set aside in a money market account and you haven't looked at it in a few months. You're satisfied with that amount of money there. It's important to review that because we've noticed that the interest rate would drop, say, from 3 or 2% down to 1. And over time, that does add up. So it's important to pull out your bank statements or go online and look and see what type of interest you're earning on those reserve funds. Even a small amount of interest is worth having a conversation with the banker, or you could bring that money in. We have money market accounts that are pretty attractive given today's rates that could help you. So always review that first. This also helps if markets are volatile during periods of volatility to have comfort knowing that you've got income set aside or you've got short-term goals, whether that be a trip or a charitable gift or some type of short-term goal, you've already allocated for that. We do this for our clients in review meetings, and that's why we always ask you, tell me about the amount in your checking and savings. Second, consider dividends. We always think about this in the standpoint of if a company you own is going to pay you an income to own those shares, generally speaking, those perform well over time. You did see the charts at the beginning of this webinar highlight how growth has outperformed, but over a long cycle, value is still a performer, and those companies would be able to provide you with income, even if you didn't spend it, if you just reinvested it. That's buying more shares ongoing, and that's smart. It is wise. So again, going back to reviewing your cash position, perhaps you've got too much that you've accumulated in cash, and it makes sense to buy companies that would pay you to own those shares. Third, rebalance concentration risk. You've seen, if you're a client of ours, you've seen communication 2 times this year with regards to this, once in January and once this month, where we have taken steps to trim out positions and rebalance that to help you stay current with your goals. This is the ongoing active management that we provide for you and will continue to do going forward. Last year was a great year, and of course, that was shown up most evidently in your large cap growth equities that performed really well. So we were able to trim that off, bring you back to the target allocation percentage that we've set for you, and reinvest that across other areas to help you. Again, I think that makes sense in light of where we are. If you're already a client, this has been done for you. You can breathe a sigh of relief that we are actively managing the money for you. If you're on this call today and you're not a client, know that that is part of the service that we provide for you. And then lastly, let's think about maintaining a long-term outlook. As Jen highlighted, since 1980, the market has always been down intra-year. And then for the full years that it's closed down, that's 10 times since 1980. It's pretty good odds if you're invested 100% in the large cap growth area or the S&P 500. Most clients are not 100% equities. So it does allow us great conviction to have you invested in good quality, you're earning dividends, and you're having an active rebalance going on. So those are actions, some we would ask you to take, some we've taken on your behalf. I think it's also important just to take a moment, take a deep breath, pause for a second. Since February 28th, that's a Saturday when the US launched those initial strikes, the market's been up and down, and the news headline of the day is varied. But if you take a 50,000 foot view out, let's go back to 1980. There have always been negative headlines. The risk is there. When you invest, it's not without risk, but we also know what those risks are. And we can look back at the last 10 years, for example, and see that there's been 2 negative stock market years. In fact, 2022 was negative on the bond market too. And realize, okay, we weathered that storm, and those results over that 10-year decade have been positive, annualized for every year. So there is some conviction that we have around the work that we do to help you. We would ask you to, take a deep breath, know that the sky is not falling. These time periods, while they could be and most likely are concerning, they're not cause for you to, toss the baby out with the bathwater, as they say, or to abandon a well thought out financial plan. J.A., you think I've covered all of those?
Yeah, that's great. That's a great point. I mean, we have to take the long view approach, and if just going back to that chart that Jen had again, if we're trying to jump in at a market, it's easy to make a decision to jump out when you get back in, So we try to be smart, and Greg communicated the changes that we've made this year in rebalancing and taking into account where we are as an economy and what areas have done well. We don't want to get too concentrated in, yes, we want to be invested in AI and large cap, but also mid and small cap companies. We see they're a better value right now, and we see potential for growth similar to how the large companies have grown over the last 18 to 24 months. So great points there. We always like to close out our webinars with the slide we title Biblical Wisdom and Truth. And today's verse comes from Psalm 19, chapter 19, verse 14. Let the words of my mouth and the meditation of my heart be acceptable in your sight, O Lord, my rock and my redeemer. And just a couple things to point out here. One, we do believe we have a rock and a redeemer in Jesus Christ, our Lord and Savior. And two, for the team here, he really is our example that we are striving after and seeking to follow. So we're in this industry there's a lot of rules, highly regulated, a lot of compliance things, but the standard that we follow is Jesus, and it's a much higher standard. In fact, it's impossible standard for us to achieve. But it doesn't mean that we don't come to work every day and strive after it. And it is why we need a savior in Jesus Christ, right? None of us can be perfect, but he was perfect. And so many of you can relate to that and believe that. And if not, know that this is a prayer for us as a team. This verse here, let the words of our mouth and the meditation of our heart be acceptable in your sight, O Lord, our rock and our redeemer. So with that, we're going to close out things for today. And we thank you for joining us on the webinar today. We're here to help folks, to serve folks. And so if you have questions about anything we've touched on, or if you have friends, family, loved ones, neighbors, coworkers who you think would benefit from reaching out to us and having a conversation, then please let us know. And we do enjoy coming to work and helping folks every day. And we appreciate the opportunity just to continue to help more folks. So keep us in mind on that. Greg already mentioned we do have our next webinar, July 27th. It'll be another 4 p.m. webinar. But outside of that, we appreciate the opportunity to serve you, and thank you for your time. Thank you for joining us today. And we hope as the weather warms up that you guys have a great summer. So take care. God bless.
Quick,
Friday.
what did you
Go
say?
ahead, Greg.
About Friday.
Yeah, I was just going to say webinar is Friday, or
Shred event.
Shred event.
Yeah. Yeah.
Don't forget to bring your
commercial.
shred items to the office here on Friday. If you're local, we'll have the shred truck out here from 10 a.m. to 1 p.m. And we may have some treats for you as well. So we'll see you there.
Bye.
Bye, everybody.
Bye-bye.